This is Jay Martin.
All right, Locke, thanks for coming on the show. I appreciate it.
Thank you for having me. I'm really looking forward to the conversation.
Okay, well, a good place to start, a place that I like to start is to understand your portfolio, where you're putting your wealth right now, so we can understand a bit of context where you're coming from. So can you speak to that, Locke? Where is your wealth stored right now?
That's a good one because I'm not like a professional investor. I'm more of a professional student of the business cycle. But in terms of my own assets, I think of it as kind of risk on and risk off. That's, it's kind of cycle up swings and cycle down swings is the way I'm built, the way I see things. And so I've been leaning towards the risk off generally. I mean, look, I'm middle-aged. I got a bunch of kids. I'm not retired, so my portfolio's roughly in line with what you might think for that. But I've been more risk off, largely because I'm looking forward to going risk on, but not yet.
Interesting.
It's just not yet. So really, when you have a cyclical framework to things, it's not market timing. I'm not top ticking or bottom ticking anything, but I just see kind of a risk reward ratio as roughly binary. And so at some point, the current downswing will kind of run its course, and certain cyclical forces will gather for a sustained upturn. That's not yet, so I'm still basically more risk off. So it's probably in like equity versus bond kind of world. I'd be tilted more towards bonds than equities, roughly speaking, that kind of thing.
Now, validate that for me a little bit. Why are you risk off right now, Locke? What are you seeing that's concerning you, keeping you pessimistic?
Yeah, so I've been looking at real time, been pretty engaged. Probably started looking at the markets in the mid 1980s. Okay. I was doing a Euro pass and I was running around Europe and busting my budget every day, right? I had a certain budget, daily budget, and I would break it, but the dollar was strong in the mid 80s. And I was like, oh, this is interesting because this free market exchange of currencies is working in my favor. Just as it's good to be lucky, just as it was happening as I was a kid. And I thought, wow, this macroeconomic stuff is quite interesting, the way that the cycles are impacting the markets. And so I've been actively watching the markets since the 1990 recession, real time, really looking at them closely. And when you're in a cyclical downturn, overall, that means the economy outside your window, activity, the various measures of it are decelerating. There's a headwind for earnings growth.
Yeah.
Which is a key component of the returns on some riskier assets. I mean, it's not quite this simple, but eventually the slowdown or recession, if it ends in a contraction of the economy, those eventually weigh on the demand destruction there, eventually weighs on the pace of inflation or the demand for money.
Sure.
And then that tends to kind of benefit, if you had some bond exposure in those circumstances. More importantly, we were talking about this a little bit before, more importantly, it puts you in a really good position to take on risk around the bottom of the cycle, right? You can kind of reallocate or tilt your allocation back toward embracing risk when there's a cycle upturn. Unlike other investors you might talk to or different opportunities that people will see, we're less about very specific investments and more about the big picture. What's going on in the backdrop? Is the wind at your back or is the wind in your face? That's really kind of the way I'm approaching it.
Hold up, quick interruption to shout out one of our partners here at the Jay Martin Show. This is Masterworks. Now, Masterworks is a platform that gives retail investors like you or I the opportunity to fractionally own pieces of blue chip art. So we're talking about Picasso, Monet, Banksy, etc. Now, why is this exciting? Because the smartest money that I have on my show invests in the art sector. So I want to do that too. Now, last year, I actually bought 2 pieces of art for my home. But knowing nothing about the art industry, I have no idea how they're actually going to appreciate over time. Now, I like them, and maybe that's enough. But if I want to put my cash to work in the art sector, I really want to go after the biggest names in the business, the multi-million-dollar pieces. And this is the access that Masterworks gets you. So check out masterworks.io now. And so can you compartmentalize that for me a little bit when you say is the wind at your back or is the wind at your face? Because that probably varies sector by sector, right? I was moderating a panel at Mark Skousen's Freedom Fest in Vegas last week. And Mark turned to me and said something to the effect of, hasn't Canada been in a recession for 10 years? And I said, well, not if you're a real estate investor. It depends on where you're looking, right? And so
that's true.
Talk to me about that right now. Where are you concerned, or what concerns you specifically right now in the broad economy and business?
Well, So first, let's just 30 seconds on what a cycle is, right? So a cycle is, I'm going to use more specific terminology here, a pronounced, pervasive, and persistent rise or fall, depending if you're in an upturn or a downturn, in output, like stuff you're producing. It could be producing this interview. It could be producing a car.
Sure.
It could be producing a barrel of oil. That's stuff we're producing. So output, employment, those are the really big ones. And then income, broad measures of income, and sales. Again, much broader than retail sales, all the sales that are going on in the economy. Now, those 4 measures tell us what's going on outside our window. Like, how is the economy right now?
Mm.
And I think most people, there's a lot of forecasting and prognostications and opinions and all this stuff, but it basically boils down to trying to nowcast. How is the weather outside right now? That's kind of what, even big data is great. I love big data, but getting a lot of data really fast and analyzing it or interpreting it kind of tells you what's going on now. That's right. Basically what it does. So if we're in, so looking at those indicators, and this is what my mentor's mentor did. Okay, so I'm telling you stuff that happened a couple generations ago.
Sure.
They were looking at those indicators and saying, look at them together, and they tend to accelerate and decelerate. That's what they do. Mm-hmm. That's the nature of a free market oriented economy. Okay. And others would say it's the Achilles heel of the free market economy, right? So the recession is when everybody gets upset and they're like, wait, all the policies are wrong, all this stuff is wrong. Well, it's actually not a bug, it's a feature. It's part of a free market oriented economy. That's what they do. Accelerate, decelerate. And the deceleration can be very, very painful if you don't see it coming, right? You could say, I'm all in on these risk assets, and then boom, they correct. And that's painful. But it's actually part of the environment in which we're all operating, at least as far as we could tell, right? There's mostly free market oriented economies around the world. There's interventions, but generally they tend to be free market oriented economies. Now, the thing that we've been working on, my generation of this work, my mentor was an inventor, the creator of leading indexes. So this is simply a fairly short term, not day trading, but not long-term forecasting, a fairly short-term, looking at a couple of quarters, trying to anticipate when output, employment, income, and sales are going to, as a group, bottom, or as a group, peak. That's all we're trying to do. What's the risk of the trend, whatever the trend is, breaking and going the other way? Because at those inflection points, if it's at the bottom or the top, at those inflection points, that's the moment when most mistakes are made in decision making.
Sure.
Okay? Because you're kind of used to this trend, and even though some people actually explicitly do this in models and very sophisticated modeling, other people may do it intuitively, just I have a hunch. If the trend is going, it is going to keep going. And so at the inflection point, by definition, the trend breaks. The mistakes are bigger.
Mhm.
And that's where I'm really focused, are these inflection points, the peaks and the troughs. And leading indicators are intended to kind of flag when those are nearby, when we're near one. Okay. Easier said than done. Okay, that's all nice in theory, but to actually in practice do it, pretty darn hard. And as it turns out, so that's what my mentor was doing, Jeffrey Moore, and it's an important question, and it's very hard to do. And at the end of his career, before he passed away, we'd spend a lot of time talking and over meals. Lunch was a great one. I would learn everything, long lunches, and he said, hey, one of the things that sticks with me is, he says, you're doing very well, extremely well as a forecaster, if you can recognize a recession when it is starting. This is from, basically the man who invented the way of forecasting recessions, he's just like setting the stage. It's really hard to do. Okay. Now we've been trying to advance this work, and he was part of advancing this work. But we've done a lot of things. He passed away in 2000. And what it boils down to is there's no holy grail. I mean, big surprise in terms of economic forecasting. There's no holy grail. And it takes right now to forecast the US economy, we're looking at over a dozen leading indexes. And to your point about sectors, okay, there's the construction sector, has a different cycle than cycles in services activity, which has a different cycle than cycles in manufacturing activity. And the cycles in each of those sectors are most pronounced in things that are discretionary, meaning that if I was feeling a little uneasy, I was feeling a little risk off, that I had the discretion of holding off on doing something. So manufacturing, let's say a washing machine, a refrigerator, a car, some tools, something like that. It's a bigger ticket item. Maybe I can get by with not replacing it or fixing the one I have for the time being. There's some discretion there, right? Construction, there can be some discretion on starting something or the speed in which you're doing something. Yeah. Okay, you have some discretion around that. Services, there's discretion. There's some things that are totally discretionary, like maybe a vacation or going out to eat, or even like a movie or something, right? Renting a movie. And other services that are non-discretionary, like you got to go to school, or you need some medical assistance, or some child care. There are certain services that you have to have, right? And so the cycle becomes more apparent in the discretionary stuff. So it's really big in manufacturing, pretty big in construction, because the excesses tend to get a little bigger in construction. And in services, if you're in certain spots, it's quite big, right? Discretionary services. And so we will often see, well, we have indicators for each sector, but we will often see like a two-speed economy, one sector going one way and the other sector going the other way in terms of the pace of growth. Yeah. And so housing is an important one. And just one more thing before we move on, there's cycles in growth. Okay, most people are thinking about cycles in that way. There are separate cycles. And this is very, very important to understanding the world. Separate cycles in inflation. A lot of models that are run by Wall Street and other professional forecasters, the vast majority of them have an equation built in them that links growth and inflation together. If growth is strong, then inflation is strong, those kind of things, right? And what we find in our cycle research, and I'm talking over a century of research here and over 22 countries, is that, yeah, they're loosely related, but a cycle in one, say inflation, can turn at a different time than a cycle in growth. And being able to discern where you are in both cycles at any given time is pretty important to understanding all the information that's washing over us, right? We have so much data coming in. How do we make sense of all that stuff? Or even do we pay attention to it at all? And then there's a third cycle. Let me just finish this out. There's a third cycle, which is a cycle in employment, which could get interesting in the current environment where jobs are kind of hanging in, even though other things are decelerating.
Well, it sounds like you're describing what's occurring right now to a degree, right? We're seeing a slowing in growth, a rise in inflation. The employment bucket is less clear to me. And I've actually got a lot of questions about that because, there's a significant labor shortage across so many different industries right now. And, call it like post-COVID wake up in the restaurant, food and beverage industry. A lot of restaurants aren't able to open full hours right now because they just can't find the staff, right? And so they've been given the green light to get back to business, but they can't because they're short staffed. And so number one, we're definitely seeing slow growth. Would you agree? We're definitely seeing an increase in inflation. Would you agree? And I've heard you say it's not transitory. It's not runaway inflation. It's cyclical inflation. If I got that right. Yeah. Okay. I'd love to understand what that means better. And then share your thoughts on where we're at in the employment cycle and what you're seeing there.
So just setting the stage for kind of where the cycle is now, right? We had the COVID recession. Right? We like to forget it, but we all remember it. We have that muscle memory of that event, right? And at the time, when understanding how cycles work, we declared really early on in April of 2020 that this is going to be a very short, a very nasty recession. But the key thing is short. And it turned out to be the shortest recession ever, right?
Right.
And the rebound. So first off, just right there, in terms of risk management, the end of recession is a risk on moment in a cyclical vantage point. I understand that the headlines were horrific in 2020, and they would scare the bejesus out of anybody. But from a cyclical vantage point, that framework, it's a risk on period. Okay, I just want to so that's less bonds, more stocks kind of. I'm oversimplifying it, but just it's a risk on moment. Okay.
Yeah.
Then we get to in terms of the cycles, and so that's the cycle in growth to the upside, very sharp. Then cycle in inflation gets going. Okay, separate cycle, and that gets going by the fall of 2020. We have an inflation cycle upturn. It gets quite extreme. It's very extreme. Our forward-looking data on the inflation cycle, which leads by a few quarters, went to a 33-year high, just to underscore how extreme it was. That's a very fast move. And this is juxtaposed against policymakers saying it's transitory. Something that's cyclical, again, as we said at the beginning of the call, is pronounced, pervasive, and persistent. It's not transitory. And so here we are in a very strong recovery, growth rate cycle upturn in growth, inflation cycle upturn. Yet the policymakers are, so concerned about what happened in the rearview mirror instead of looking forward. That you've got the Fed with full quantitative easing, low interest rates. We're not worried about inflation. And on the fiscal side, there's additional stimulus checks. I understand there were some in the heat of the moment, but then they just kept coming. There were more and more of them. Okay. Now, all of this is going into an economy that is struggling with shutdowns, right? We're not open yet. So you can't go out and consume services that much. So you're going to consume goods. But the capacity to deal with your goods purchases, you meaning everybody, right? the capacity to deal with those purchases doesn't exist. So any kind of good related inflation, including commodities, shoot to the moon. Now, 2021, we start shifting into reopening. So there's a little bit of reallocation of spending away from goods toward services as the economy is reopening. And the services companies, and we work with these companies, by the way, right? So they're sitting there, these really big services companies, and so they've made it through the drought of no demand for services, and now everybody wants services, so they're selling forward like crazy. This is where you book your vacations, and you all this stuff gets sold forward. Yeah. People are all consuming that right now. Everybody's consuming those things that were sold earlier now. And so when you go to the restaurant, or you go to Disneyland, or you get onto the airport, the whole thing is overwhelmed. It's a lot of pent up demand that you're seeing in the coincident moment. But you need to look forward, right? We need to anticipate, where is this headed? Is the stuff that's happening right now outside our window going to resemble what's going to happen in a quarter or two? And the leading indicators say no, it won't. It's going to be substantially weaker. Okay. And when we look at these metrics again that define where you are, not forward looking data, but that define where we are, output, income, and sales, they all are looking downright recessionary at this point. The broad measures of those characteristics of economic activity, coincident activity. Employment is still adding jobs, and you can't have a recession. A recession is not happening if you're adding jobs. Right. So it helps us understand that there's not a recession unless the data on jobs data gets substantially revised, that there's not a recession in this instant. Yeah. But when we look at the growth in employment, it's decelerating pretty noticeably. So the prospect of a recession beginning is, I think, very, very high, and it could come sooner than people think. And this is related to my comment on Twitter that there's a lot of people who are saying the word recession, right? And so that speaks to the recognition of the slowdown. Finally, I mean, the slowdown's been going on for well over a year, but finally people are recognizing that it's happening. And I think that then that's why the R word, so-called R word, comes up. But I don't think people, I've been studying this stuff, as I said, since 1990, full time. And I don't know anyone who has a very good track record of forecasting recessions. In fact, I agree. The overwhelming evidence is to the contrary. And people forecast often. If you're going to forecast often, and some of them will look good, and in this game, there's not that many recessions and recoveries, right? There aren't that many. Yeah. And so you have to be careful when you're doing it. And we have a really well-developed process that we go through. We're not winging it. Very, very objective set of things that we're looking at to get to the determination. And so that's the culmination behind my statement to you that, recession is very, very likely here. It just hasn't started yet.
Can I ask you a question about self-fulfilling recession? So what I mean is, you nailed it. You said in your tweet, suddenly everybody's a recession expert, right? Yeah. And we're all seeing this. Every headline's calling for some variation of a recession. And I always look at doom and gloom headlines with a lot of skepticism, because pessimism just sells better than optimism, right? Pessimism 100%. Sounds like somebody's trying to help you. Optimism sounds like someone's trying to sell you something, right? Mm-hmm. I mean, that's often how it's interpreted. Plus, you sell the pessimistic headline, you trigger the fear response, you get the click. That's the media business. And so it's always going to be more abundant. I had a conversation with a handful of entrepreneurs recently, all successful, self-made business owners. And we were going around the table sharing our economic forecasts. And everybody was pulling in things that they had heard from mainstream media to forecast the future. And I found myself sitting there thinking, why on earth are all of us as business owners with employees and client bases looking to mainstream media to tell us what the economy is doing when in fact, this room is the economy? Businesses with employees selling products and services, we're the metric. It's right here in this room, yet we're looking outside for validation from third-party media who's just commenting, right? However, we see the headlines and entrepreneurs still respond to them by maybe cutting investment, cutting costs, freezing salaries, reducing new hires, all of this stuff. And we kind of create the result that the media is forecasting. And in that sense, it's almost self-fulfilling. Is there some validity to that, or what do you think?
Yeah, it's a great question, and I want to come at it in several different ways. First, I want to tell you how we put together the components that go into our indicators, not literally, but just qualitatively, because it speaks to your point. Second, I want to talk about a couple of different groups that we work with. One are business managers, right, the C-suites, and the other are the investors, and they kind of, they're not really the same. These are different groups of decision making. So first on this idea of self-fulfilling prophecy, the reason models don't work, I don't want to offend anyone who works on models. I mean, I know
Go ahead, offend.
You need models because you have to have scenarios and budgets and scenario A and scenario B, and models are fabulous tools for that. And away from turning points, models can work quite well. Okay, so I have a lot of affection for models under the right circumstances. For the purposes of turning points, is there a turning point ahead? Models are quite poor. It's the wrong tool. That's what I mean when I'm kind of knocking a model. Now, the thing about models is that they have a really tough time dealing with psychology. Right. I mean, every once in a while, like there's some big calamity and the models miss something, and they'll say, oh, we got to add in more behavioral stuff or this or that. But the thing is, at these inflection points, they happen quite suddenly, both sides. And what you're getting down to is this really base human condition of fear and greed. Those are real, and they make a difference.
Right.
And that's kind of that's the base. That's, if I push what you're saying all the way to this extreme, it's fear and greed. And when we are putting together our forward-looking indicators, we will look at what we call hard data. This is where you're counting things. The government tends to do this. They're counting up jobs and sales and production, and it's very hard government data. That's what we call that, and it gets revised over time because they're making some estimates, but eventually settles down, and it's a record of what happened, of actual stuff that was done. Then we look at market data, so that's all the prices for everything you're paying and buying and selling, and the market data, hey, look, whatever it is, it's worth whatever you traded it at the last moment. And that's a real thing. That's a hard moment in time. It's a measurement. It's real. So we look at that. It's the culmination of everybody's opinion at the moment. And then there's survey data or soft data. And that's the psychology stuff. When I say to you, hey, are you going to buy a car? And you're like, I don't know, it's not the best time. Maybe I will, maybe I won't. And that has all kinds of weird biases in it. It's totally messy. But they tend to kind of, if you look at certain components, they tend to kind of move in patterns that may sync up with other data. So those are our three inputs, buckets of inputs. And so psychology figures very largely, I would say, in our assessment of things. So the self-fulfilling component is part of what I would call either the vicious cycle, when things spiral out of control to the downside,
Yeah.
or the virtuous cycle where, hey, screw it, I've had enough, jam the torpedoes, I'm going to go out and do something. I'm going to spend some money. I'm just done. And we've all been there too.
Yeah.
When you get to these decision makers, business managers, the business managers are interesting. I think in some ways, business managers are more attuned to the cycle, but in a very coincident way, not so much in a forward-looking way. They're reacting to what's coming through the door, right? And so so they're very attuned to what's happening right now today. How much did I have a good morning in business? Did I have good traffic in the afternoon?
Yeah.
They're very good on that. And so they're very good coincident barometers of economic activity during long periods after the financial crisis, after the 07-09 recession. We have all the quantitative easing and just tons of money, and the market type investors, the other set of people that we work with, a lot of them got pretty happy because, hey, the Fed has my back. So they're inflating assets. So I don't really have to be a genius. I could just be in it. Yeah. And maybe I got to pay attention to the Fed and how much they're pushing, and that's kind of it. And maybe the cycle, there was a whole period pre-COVID of this macro is dead stuff, right? And it was mostly out of the investor side, not at all out of the C-suite side. C-suite side saw all the cycles, right? There's a big fat manufacturing recession in 14, 15, 16 that they all wrestled with. And cycles in real estate and in housing. So I think the business managers in a way are really good on the coincidence stuff, actual activity. And I think the investors, they get a little, understandably so, they're a little fixated on liquidity. Yeah. And, those kind of things that are pushing markets around.
That makes sense. Okay. So based on what you're seeing now, give me some quick thoughts on a few key topics of interest. So in inflation forecast, near term lock, are you expecting, we just hit, what was it, 9% a couple of weeks ago, last week? You expecting that to increase or decrease at the next print?
Well, the next print, I don't know, because that's like, in my world, that's like day trading. The next print.
Sure. Okay. Yeah. Good point.
It's super short term.
I appreciate that. Yeah.
I would say directionally, the direction, the peak is in around here. I don't think we're running away, and part of that is looking at our forward-looking inflation data, which had earlier run up, and then it's chilled out. It's not continuing to accelerate. Okay, number one. So that's the number one reason. The second reason is, I'm going to go back to my lunches with my mentor, and where I think one of the other things he said was, there's not a lot of truisms in economics, but one that comes pretty darn close is that recessions kill inflation. And as I've said earlier, it's not a bad word. Look, recession is not a bug; it's a feature of a free market-oriented economy.
100%.
And the odds are extremely high that we're going to go into one. Now. It is not unusual for inflation to rise into a recession. Okay, I just want to make this clear. That could happen. In 2008, we were well inside the recession. I think it was in May and June, and based on oil being up in like the 140s, approaching 150s range, the Fed and the Fed funds futures markets were pricing in 100 basis points of tightening before the end of the year. This is 6 months inside a recession. So I just want to, that happens. The other thing that can happen is jobs growth can continue right up to the beginning of the recession, and sometimes a little bit into it. It's more extreme, but that can happen under certain circumstances, and happen in the mid 70s. And in this environment, with so many people having left the workforce and not all of them having unretired, right? There's a little bit of tension there. We've got record low, really low unemployment. And there's, even though the economy slowed very, very sharply, there's enough demand there, as we see when we go out this summer, that you need to hire people. So there's still some jobs growth left. I don't know. I wouldn't be surprised if that falls off quite a bit
Right.
after the summer's over and we get into
Yeah.
the fall and into the winter.
Okay.
Now, the other thing, I'm going to kind of rhetorically ask myself and answer a question here, because it's something I'm hearing, and you
Sure.
might be, now that I say it, you might realize that it's happening. When you're hearing the recession discussions, such as they are in the mainstream media, there's this thing of like, yeah, maybe we'll have a recession, maybe it'll be later, right? So they're kind of hedging their bets. I'm going to say the word recession, but not right away. And so I kind of have my cake and eat it too, in terms of what I'm saying. And then if we do have it, it ought to be mild, because everybody's balance sheet is pretty good. Either consumers,
Sure.
in particular, not the lower end consumers, but other consumers or businesses. And so therefore it ought to be mild. And I understand the logic there. I don't know if it completely holds up. I think the consumers are under a bit more pressure, including higher end consumers, because when the stock market falls or home prices don't rise like they used to, right? Then that wealth effect that the higher end consumer enjoys in the upswings starts to get eroded. It's not that technically you can't consume, but psychologically you start to get a little bit slower. But one of the things that's catching my eye, and I've been around long enough that I've seen this before, is that globally, right? We look at 22 economies. So globally, the leading indexes are to the downside. There's a bunch of recession, either outright recession or recession risk around the world. And so therefore, there's no clear locomotive of growth anywhere to offset the decelerations that we're seeing elsewhere, including in the United States. Global downturns tend to be more severe. I'm talking in generalities here.
Sure.
But that would make me a little more concerned to the downside.
Yeah.
And this is a little unusual, and it really speaks to the policy mistakes that were made everywhere. The central banks are playing catch up on inflation. And so when you have a cyclical slowdown, so the car is slowing of its own accord already. And then the driver here, the Fed, is stomping on the brake. That is the situation we're in. We have not only the United States, but many banks around the world tightening. And so that combo of a cyclical downturn, which is reasonably sharp at this point, and hitting the brakes hard, I wouldn't be surprised if the car stopped. And here we're more globally discussing. And then you have events, right? So you have, I mean, it's not that China wasn't slowing. China was already in a cyclical downturn. They've got a whole bunch of debt-related real estate issues that limit some of what they do. Yeah. And then on top of that, they got the zero COVID stuff, and COVID's percolating. So they're stomping on it even harder. Yeah. So all of that's just like bad luck on top of what I already said. So, you know, investors or you might have to, it's not that I'm ultimately bullish, right? This thing's going to turn on the other side and go up. I just am holding, keeping my powder dry, or whatever you want to call it. It's not yet is basically the sum total of what I'm saying. Okay. Look, I think that's a good place to wrap it, Locke. I appreciate that, man. And lots of gems in there. So thanks so much for your time. I appreciate you coming on, and I'd love to do it again sometime. Yeah, no, that's great. And we continue to put out one index publicly, because most of the stuff I do is work with these where can I point people, Locke? Where can they find your work? Where can they? I think the easiest place these days is just on Twitter, at Business Cycle. And if you go to @Business Cycle, we'll stuff that we say publicly ends up there. And one thing we try to put up there is this weekly leading index. It leads the U.S. economy, the growth there, and it's available every Friday. @Business Cycle. At Business Cycle.
A hell of a Twitter handle. All right.
There you go.
All right. Thanks, man. I appreciate it.
All right. It was my pleasure. Thanks for having me.
All right, thank you for watching this interview. Now, 3 things before I let you go. Number 1, I publish a weekly newsletter and I love writing it. I share my biggest takeaways and action items from the conversations that I have on this channel. In addition, my thoughts on current events, economic events, political events, and you can subscribe for free. Just hit the pinned comment right beneath this video, or just go to jmartin.club and you can subscribe on the website. I'd love to have you join the team. Number 2, ad revenue from this channel is donated to an organization that is super close to my heart called Zero Ceiling. Now, Zero Ceiling's mission is to end youth homelessness, and the way they do this is by giving at-risk urban youth the opportunity to relocate to beautiful wilderness areas and then provide them with supportive housing, career training, and just generally positive influences on their life. I love what they do. Check them out if you're interested. And number 3, if you prefer to listen to my content as opposed to watch it, you can find me wherever you listen to your podcasts. Just search for The Jay Martin Show. All right, thanks again.